Are you looking to purchase or refinance a home and you're really not understanding all the mortgage lingo that gets thrown at you? Problem is, being in the industry for so long, sometimes we forget that we have to slow down and really explain all these terms to all of our clients. And if this is the first time you're checking out my channel, my name is Uyehara. I'm a sales manager with Loan Depot, helping you finance your homes all across America. I've got 60 mortgage terms. I'm gonna go through this list as fast as possible, so let's hop right in. Adjustable rate mortgage, or ARM. These are loans that are fixed for a certain period of time, and then after that fixed period is up, it starts to adjust based on the index that it's tied to. All cash transaction. This means you're a cash buyer, you need absolutely no financing, you have the funds needed to purchase without a loan. APR, or annual percentage rate. This is not the rate that is used to calculate your mortgage payment. This is the actual yearly cost of the funds over the term of the loan. Appraisal. This is an independent report that a lender uses to determine the estimated value of the property that you're purchasing or refinancing. Appreciation. This is the increase in your home value over time. The appreciation in your property creates equity, which is then funds that you can use to either borrow against, or when you sell your property, it would be looked as proceeds back to you from the sale of the home. Assets. This could be funds that are in your checking, savings account. We can use other property as assets, or even your retirement accounts could also serve as assets during a transaction. Balloon loan. This type of loan has a balloon payment, hence the name, at the end of its loan term. You might have a 10-year term that whatever balance is owed at the end of that 10-year term is due in full at that time of the loan being matured. Cash to close. This typically includes your down payment plus your closing costs, and it's going to be the final number that you're going to have to wire to end up closing on your property. Certificate of eligibility. This is a certificate issued by the federal government to certify a veteran's eligibility for a VA loan. COE, or close of escrow. This is an important date on your contract because this is the intended closing date to have everything done and the day you're going to become a new homeowner. Closing costs. Other fees that are associated with a purchase or refinance transaction other than the down payment that gets charged and due at the final closing. Closing disclosure. It is a form that describes in detail the critical aspects and closing costs that are associated with your mortgage loan. This includes your purchase price, your loan amount, closing costs, and all other expenses affiliated with the transaction. Conventional loan. This is a loan that is not backed by a government agency. These loans are backed by Fannie Mae and Freddie Mac. DTI, or debt to income ratio. This is calculated by taking your monthly minimum debt that's on your credit report and dividing that by your gross monthly income. Deed. This is a document that legally transfers ownership from a seller to the buyer at the closing of the transaction. Discount points. It is an additional fee that a borrower can pay upfront to lower their interest rate. More often than not, it's going to be expressed in terms of percentage points. 1 point is equal to 1%. Down payment. This is the amount of money that you're going to be needing in order to purchase a home. Almost every single mortgage requires a down payment, except for VA and USDA loans. Earnest money deposit. This is a deposit that is required upfront from the borrower when you are purchasing a home. Most often, it is required within 24 hours of your offer being accepted by the seller, and it is basically your good faith to show the seller that you are willing to purchase their home. Escrow. This is a third party that helps manage the entire real estate transaction. This is where your earnest money deposit gets held. They disperse the funds at final closing from the lender. They are basically an intermediary between the buyer and the seller, and they work off the instructions that are based off of the purchase contract. Exceeding home value. This is a great thing. This happens when your appraisal comes back higher than what your contracted sales price is. So for example, you're in contract for $100,000 to purchase a property and your appraisal comes back at $110,000. That means you are walking to some instant equity in your property. FHA loan. This is a loan that is insured by the Federal Housing Administration. Many first-time home buyers take advantage of this loan because of its credit requirements as well as the lower down payments. With an FHA, you can go as low as a 520 credit score and get financing, and these loans typically only require a 3.5% down payment. FICO Score. There are 3 different credit scores that every lender will look at qualifying a client for a home loan. Those credit bureaus are Experian, TransUnion, and Equifax. Fixed rate mortgage. This is when you have an interest rate that is fixed throughout the lifetime of the loan. The most commonly used fixed rate mortgage is a 30-year fixed loan. Forbearance. This is when your mortgage servicer or lender allows you to pause your mortgage payments for a designated period of time. Foreclosure. This is the legal process of the bank being able to take back the property or the asset that was used for a home loan. This typically happens when the borrower who's been living in the house has stopped making their mortgage payments and is now in default. Funding fee. This is a fee that is affiliated with the VA loan. This fee helps to reduce the cost to U.S. taxpayers since the VA loan has no down payment and no mortgage insurance. HOA dues or Homeowners Association dues. These fees are usually associated when you live in a master plan community, and the fees usually help maintain all the common area maintenance that's associated either with the building or in the community that you live in. Home inspection. This is one of the most important inspections that you will do when purchasing a home. You will typically have a third party go out and perform the home inspection. They will go through everything in the property from plumbing, electrical, to the roof. If you can think of it, they will probably inspect it and give you a report once they've completed their job. Homeowners Insurance. This is a policy that insures your property and protects it from fire or natural disasters. If you are financing your home purchase, your lender will require that you have homeowners insurance at the time of closing. Interest rate. This is the rate that a lender will use to calculate your mortgage payment. This is what's usually advertised online and how many people shop for their home loan. Interest-only mortgage. This is a type of mortgage that was used during the subprime market. Many people chose this option because it had a much lower payment because you're only paying interest on your loan. Today's loans include principal and interest, so traditionally the payments will be typically a little higher than paying just interest on your mortgage. Investment property. This is a property that's purchased to then rent out and earn passive income. Jumbo loan. This loan exceeds the conforming loan limit, which is set by the FHFA, which is the Federal Housing Finance Agency. They typically set the conforming loan limit every single year. So make sure you check with your lender to find out what that limit is and whether or not you will be purchasing a home that is considered a jumbo loan or under the conforming limit. Lender. This can be a bank, credit union, or a lender like us at Loan Depot that help people purchase homes that do not have the cash to purchase the home outright. You will use a lender to obtain financing to help you become a homeowner. Loan modification. This usually comes up when a borrower who's already been living in their home is having a difficult time making their mortgage payment. They typically reach out to their lender or their servicer, whoever they're making their mortgage payments to, and ask for some type of relief. The lender will typically modify the loan terms, whether it be the interest rate, the monthly payment, or the amortization period. This could be done on a temporary basis, or they could make it permanent for the life of the loan. Locked-in interest rates. This is when a borrower communicates with their lender, letting them know that they'd like to lock in a rate so they can close on their mortgage. Traditionally, the shorter the locking period is, the cheaper the cost of the rate is. Some lenders can extend all the way up to a full year. Locked-in periods. This is a period where a borrower communicates to their loan officer that they'd like to lock in their interest rate so they can close on their mortgage. This period can range anywhere from 30 days to a full year. Make sure to check with your lender because the longer the lock period, the more expensive the cost typically is to do so. Market value. This is typically determined by an appraisal. The appraiser will go out and they will look at recent sold properties that are comparable to the subject property that's being purchased, and they have a formula that they use to determine what the estimated market value is for you to purchase your property. Mortgage application fee. This is a fee that some lenders will charge to take your application upfront. Mortgage broker. This is a third-party company that borrowers will seek out to help with their home financing. Mortgage brokers don't work for a specific lender. They are affiliated with numerous lenders and they shop your mortgage around looking for the best deal possible for you. Mortgage credit report fee. This is a fee that a lender may charge in order to pull your credit for the application. Mortgage insurance. This is an additional cost that is typically assessed when you are putting less than 20% down on a home loan. Given there are ways that you can eliminate your mortgage insurance, but this is the most common example of when mortgage insurance is charged on a transaction. Loan to value or LTV. In order to calculate your LTV, you are simply dividing your loan amount by the property value. Origination fee. This is the fee that a mortgage lender will charge in order to complete a mortgage. PITI. This is one of the most commonly used acronyms in the mortgage industry. PITI stands for principal, interest, taxes, and insurance. Those 4 items make up your mortgage payment. Points. If you remember, we also discussed discount points. These two are used synonymously throughout the mortgage industry, and they're the same thing. Basically, you as the borrower, you are paying your lender additional costs or fees associated to buy down your interest rate and get a lower rate upfront. Pre-approval. This is when a lender will pull your credit and verify your income, assets, and everything associated with your loan application up front to make sure that you can purchase a home. Pre-qualification. This is when a lender typically does a verbal application over the phone. They're not verifying your income or assets or anything. You're basically giving them information and they can give you a ballpark as to what you can qualify for. Property taxes. These are fees that are included into your mortgage payment as part of your PITI payment that go to your local county, and it is based on the assessed value of your property. Purchase price. This is the agreed upon price that you and the seller have negotiated and come to an agreement with so you can purchase your property. Real estate agent. This is the person that helps you either purchase or list your property and represents you in a real estate transaction. Real estate broker. This is typically the owner of the real estate company. The agents report to the broker, and the broker is in charge of overseeing the office. Refinance. This applies to current homeowners. This is where you look to modify your home loan, whether you're looking to lower your interest rate, shorten your term, or you could look at tapping into some home equity and pulling out some of that equity to then pay off credit cards, purchase other investments, or treat yourself to a vacation. A renovation loan. These loans are used to help finance the cost of the renovation into your mortgage. There are 2 popular renovation loans out there. FHA has a program called FHA 203K, and through conventional financing, you can use Fannie Mae's Home Style Renovation Program. These programs help minimize out-of-pocket expenses to the buyer, so that way, again, they can finance the cost of the renovations into their home mortgage when they either purchase or refinance. Seasoned funds. In the mortgage industry, we determine that funds are seasoned to your account if they've been in there for at least 60 days. Second home. This is typically called a second home or vacation home. You can actually be a current renter and still purchase a second home. We would look at it like a vacation property. For example, let's say you live here in Las Vegas and you love the beach. You could look at purchasing a home in, let's say, Florida as a vacation property where you and your family love to visit in your off time. Seller concessions. This is when a seller has agreed to provide some sort of credit in order for you to purchase their home. Short appraisal. This happens when the appraisal on your property has come in less than what you've agreed to pay the seller for the property. For example, if you're in contract for $100,000 and the appraisal came back at $95,000, this would give us a short appraisal. You would have to then negotiate with the seller to move forward with the transaction if you are using financing to purchase your property, because as a lender, we won't finance anything more than what the house appraises for. So your options could either be the seller can reduce the price, you folks can split the difference, you as the buyer can pay the entire difference, or you'd have to walk away from the transaction due to the deficiency between the sales price and the appraised value. Total cost analysis, or TCA. This is something that my team utilizes on a daily basis. We go over a TCA with all of our clients so that you can understand how your mortgage works both short-term and long-term. This gives you a side-by-side comparison of how interest rates work and how the cost will impact you, whether you're looking to purchase or refinance. Upfront mortgage insurance premium, or UFMIP. This is also an acronym that's associated with FHA financing. The upfront mortgage insurance is financed into the loan, and it helps lower the overall down payment in order to purchase a home. FHA financing only requires 3.5% down. VA loan. This loan is eligible to active duty service members as well as eligible veterans that have served in the military. The VA guarantees this loan, and the best part about it is that there is no required down payment and you also have no mortgage insurance. And check out this playlist where I'm gonna give you my key tips on how to get your mortgage right. My name is Sean Uyehara. I'm here to help you get your financing all across America. Whether you're a first-time home buyer, move-up buyer, you're looking to refinance, purchase an investment property, or even refinance, we've got you covered. I'll see you on the next video.